Welcome everybody to this lecture in Intermediate Macroeconomics. We are in chapter 20.2, Exchange Rate Crisis under Fixed Exchange Rates. We already talked about the fact that in case that the real exchange rate has to adjust, this adjustment process might be long and tough in a fixed exchange rate system or fast and soft in a floating exchange rate system. So in case that, for example, the real exchange rate needs to change, it would be much easier for the central bank to adjust the nominal exchange rate. By making one adjustment, it could be the case that the price of Danish goods in relation to the price of foreign goods would change automatically. We don't have to wait until each and every company has adjusted the goods price and each and every labor contract has a reduced nominal wage. This was a main takeaway of the last lecture, but now we could ask the question, how does it look like in the real world? And we could have a look at two Nordic countries. We can have a look at the exchange rate of Denmark and the exchange rate of the Swedish krona against the European euro. So you can see here two exchange rates over time from January 2002 until October 2007. So this is the pre-crisis era. The blue line, this is the exchange rate, the number of euros you receive for 1 Danish krona or the price of 1 Danish krona. The red line, this is the price of 1 Swedish krona. And more or less, you can see that the exchange rate is pretty stable. The Danish krona really is fixed. We can see one straight line, but also the Swedish krona shows only minor fluctuations, but it's also a fixed exchange rate system in place. So what happened in the financial crisis? In the financial crisis, it's a case that the Danish krona is still stable. So the Danish central bank was able to defend this kind of peg. What about the Swedish krona? It is the case that here in September 2008, the exchange rate starts to decrease. So this is an appreciation of the euro, a depreciation of the Swedish krona. And of course, when the exchange rate of the Danish krona is fixed against the euro and the Swedish krona is depreciating, then also the Swedish krona is depreciating against the Danish krona. So this is what we see in the next graph. Here we see the exchange rate number of Swedish krona for 1 Danish krona. More or less, this is stable from 2002 until the end of 2007. But then you can see here that in the crisis, the exchange rate goes up. This is a depreciation of the Swedish krona and hence an appreciation of the Danish krona. Does it have an effect in the real world? Yes, it has. So some researchers were examining this relationship and how different countries were doing after the crisis hit the different countries. So in this paper, which deals about how the Great Recession is mastered, the conclusion is as follows. The researchers examined whether inflation targeting has some benefits in terms of economic growth in the crisis period 2007 to 2013. The answer is yes. Countries which have an inflation targeting in place, they are doing much better than countries which have other monetary regimes, especially when we look at countries with fixed exchange rate systems. So there are some Danish researchers and they wanted to find out whether it was costly for the Danish economy to keep the fixed exchange rate system in place, and they especially compared it with the situation in Sweden. So Sweden was able to get much faster out of recession compared to Denmark. One reason why Sweden was able to get faster out of the recession was the fact that the Swedish krona was depreciating during this time period. This is very interesting because it confirms our main insight that fixed exchange rate systems are sometimes a burden. So it comes with a cost when a country has a fixed exchange rate system in place. Given the intermediate results, one big question remains. Why should a country opt for a fixed exchange rate system in the first place? What are the benefits of a fixed exchange rate system, or what are the disadvantages of a floating exchange rate system? We get one answer to this question in the end of chapter 20.3. In the end of this subchapter, the authors talks about the end of the Bretton Woods era, where countries moved from fixed exchange rate regimes to floating exchange rate regimes. The expectations were that exchange rates are relatively stable. But it is a case that we observe very huge swings in the exchange rates. So in the 70s and 80s, we observed large swings. In the beginning, we were not able to find out whether these huge fluctuations are the results of irrational speculation or whether we can explain it in a rational way. It is the case that to some extent these large swings can be explained by rational reactions to new information with respect to future interest rates and expected exchange rates. And this is more or less what this subchapter is all about. So in 20.3, we'll talk about how does the exchange rate change in case that new information occur which are related to future interest rates or the expected exchange rate. But now we can already answer the question, why does a country opt for a fixed exchange rate system in the first place? Because in a fixed exchange rate system, it is the case that the nominal and the real exchange rates are less volatile compared to a floating exchange rate system. So in a floating exchange rate system, the exchange rate might be quite volatile, and this of course also affects international trade. So exports and imports are affected by exchange rate changes, and in case that the nominal and real exchange rates are very volatile, this might affect the real economy. Let's have a look at how the exchange rate behaved in the Bretton Woods era and after the Bretton Woods system broke down. You can see here the nominal exchange rate, German mark per US dollar. This is the black line. In the beginning, it was the case that the exchange rate was at the level of 420 German marks for $1. And then there was a long period where the exchange rate was fixed at the level of 4 German marks for $1. Then you can see already a few realignments here in the end of the 60s and beginning of the 70s. And then it is the case that the Bretton Woods system broke down in 73. And then you can see here a huge volatility. The exchange rate is decreasing in the first few years, but then the exchange rate is increasing in the first half of the 80s. Afterwards, a huge drop of the exchange rate. So the nominal exchange rate is definitely more volatile in a floating exchange rate system compared to a fixed exchange rate system. But this is not too much astonishing. So this is something we would expect, that in a floating exchange rate system, the nominal exchange rate is more volatile. But what are the effects on the real exchange rate? So you can see here the red line against the right axis. This is the real exchange rate. And in the Bretton Woods era, the real exchange rate is pretty constant. There's not too much volatility in the real exchange rate. But then when the nominal exchange rate is fluctuating, after the breakdown of the Bretton Woods system, it is the case that also this huge volatility pops up in the real exchange rate. So the volatility of the nominal exchange rate transmit into a volatility of the real exchange rate, and then of course international trade is affected. And then you can imagine that in case that international trade is very important for one country, it might be the case that this country will opt for a fixed exchange rate system, because then not only the nominal exchange rate is less volatile, but also the real exchange rate is less volatile than before. Nevertheless, in the next few steps, I would like to derive a relationship so that we can talk about this last bullet once more. Like large swings in the nominal exchange rate can be explained by rational reactions to new information with respect to the future interest rate or the expected exchange rate. And in order to confirm this last bullet, we need to derive the so-called UIP condition, the uncovered interest rate parity condition. Let's do so. In the next few steps, we want to derive the UIP condition in order to prove this last bullet I was talking about. Please keep in mind that we defined the exchange rate of the price of 1 unit of the foreign currency. So when we talk about Euroland and the US, the exchange rate is 0.8 euros for $1, which implies that the price of $1 is 80 euro cents. How do we derive this UIP condition? We are assuming that one investor has two different investment alternatives. He can either invest in the domestic economy in Euroland, or this investor can invest in the US. The investor can invest €1 for 1 year, investment alternatives Euroland or the US, and after 1 year of domestic investment, the investor will receive 1 times 1 plus the domestic interest rate. This is the outcome of the investment at home. What happens when we invest in the US, the foreign investment alternative? We assume that the investor does not use the forward rate to hedge against the exchange rate risk, but the investor has to build expectations in period T of how the exchange rate look like in 1 year from now, so in T+1. Let's assume that today the exchange rate is at the level of 0.8 euros per US dollar, and the investor expects today that in 1 year from now the exchange rate will be at the level of 0.9 euros per US dollar. We furthermore assume that the foreign interest rate is equal to 10%. Let's do our calculations. In a first step, we have to convert €1 at the current spot rate into 1 over E US dollar. In our numerical example, the exchange rate was at 0.8 euros for 1 US dollar. So we can convert our €1 into 1.25 US dollar. Step number 2, we are investing 1 over E US dollar at the foreign interest rate I star. The outcome will be as follows. So we have the 1.25 US dollar. We are investing at the foreign interest rate, which is equal to 10%. So at the end of the period, we have 1.375 US dollar. In a third step, we have to convert the initial investment and the interest back into euro, and we use the expected exchange rate, which is at 0.9 euros per US dollar. So now we have to multiply through. So 1.375 times 0.9 euros per US dollar, we get the amount of 123.75 euros. This is the expected return in case that we invest in the foreign economy. The formula for the foreign return is a little bit more complicated. So in the first step, we have to divide by the exchange rate in order to get US dollar. Then we are multiplying through by the foreign interest rate. And then we use the expected exchange rate and we multiply through in order to convert these US dollars into euros. So the formula for the foreign return is given here on the right-hand side of this equation. In case that we look at risk-neutral investors, then the expected return at home has to be equal to the expected return abroad. Let's drop the time indices here. The domestic return has to be equal to the foreign return. So on the left-hand side of this equation, we have 1 plus the interest rate. This represents the domestic return. And on the right-hand side, we have the foreign return. Now we have to do some modifications because in the end, I would like to derive the uncovered interest rate parity condition, where we have the interest rate differential on one hand side of the equation and the expected relative change in the exchange rate on the other hand side of the equation. So we have to do some modifications, but we are going through it step by step. So in the first step, we divide by 1 plus I star and put this on the other hand side of the equation, and we get to equation 2. In the next step, we subtract 1 from both hand sides of equation 2. And it's the case that we do not subtract a normal one, but on the left-hand side, we are subtracting 1 plus I star over 1 plus I star. And on the right-hand side, we are subtracting the 1 in the form E over E. Let's switch to the next slide. Once more, the formula is given here. Now we can write it on one common denominator. So 1 plus I is given here, then minus 1 minus I star, and on the right-hand side, the expected exchange rate minus the spot rate. Then we have a 1 here, a 1 there. These ones will cancel out, and we get to I minus I star over 1 plus I star is equal to the relative change in the expected exchange rate. We are almost done. A few steps are missing. In the next step, we multiply through by 1 plus I star. When we multiply through by 1 plus I star, we have on the left-hand side I minus I star. This is important because of the fact that we said we want to isolate the interest rate differential on one hand side of the equation. And then we also multiply through the right-hand side by 1 plus I star. The last term on the right-hand side is relatively small. So here, this term is relatively small. When you would take our numerical example and you multiply through, then it's the case that this relationship indeed is relatively small. The last term will be relatively small in case that the interest rates are relatively low. Therefore, we are allowed to use this approximation. So we use the approximation that the last term is very small, and it is so small that we are allowed to neglect it, and therefore we work with this approximation here. And this approximation is called the uncovered interest rate parity condition. In some textbooks, you'll find it in this way, that you have on the left-hand side the interest rate differential, and on the right-hand side the relative expected change in the exchange rate, or in some textbooks you find this version that the domestic interest rate is equal to the foreign interest rate plus the expected change in the exchange rate. This is the UIP condition we are going to work with. Please be reminded that in the Blanchard textbook you find a slightly different version. So in the Blanchard textbook on page number 413, they work with this relationship. There is a minus sign in front of this relationship because of the fact that they use the other notation of the exchange rate. In our lecture, and for example in the Krugman-Opsahl-Militz textbook, they work with this relationship here where there is a plus sign in front of the exchange rate because they also work with the price notation of the exchange rate. So now that we derive this relationship, we want to work with this UIP condition. It's a good idea to go back to slide number 11 and once more point out why we need the UIP condition and what we are going to show with the UIP condition. So the last bullet here says large swings can be explained by rational reactions to new information with respect to future interest rates and expected exchange rates. So this is the reason why we derived UIP condition, and now we are going to work with this UIP condition, modify it several times, and then we are able to prove this last bullet on slide number 11. When we derived the UIP condition, we started with the first equation. This was given by the following relationship. On the left-hand side, we have the return in case that we invest in the domestic economy, and on the right-hand side, we have the return in case that we invest in the foreign economy. From this relationship, we of course get to equation 11, so we just write this 1 plus I star in front of this relationship. In the next few steps, we are trying to solve this relationship for the exchange rate ET. We are doing that because we want to explain changes in the exchange rate by changes in the interest rates or the expected exchange rates, and therefore it makes sense to solve for the exchange rate level ET. In the first step, we divide by 1 plus I. We get to equation 12. So when we put 1 plus I on the other hand side of the equation, we get to equation 12. And now we can multiply through by ET. We put ET on the other hand side of the equation, and we get to equation 13. So here we have a relationship between the exchange rate level on the left-hand side, then the two interest rates, and the expected exchange rate for the period T+1. So the exchange rate is affected by the expected exchange rate, which is expected for the time period in 1 year from now. But what is affecting the expected exchange rate? Let's think about what the relationship, how the relationship of the UIP condition looks like in 1 year from now. Of course, in 1 year from now, it is the then prevailing interest rate in the foreign economy and the prevailing interest rate in the domestic economy, as well as the expected exchange rate for the time period in 2 years, which affect the exchange rate in 1 year from now. When we now build expectations of how this relationship look like, then we know that the expected exchange rate, expected for the time period T+1, depends on the expected interest rate in the foreign economy, the expected interest rate in the domestic economy, as well as the expected exchange rate for the period T+2. When you now look at this relationship, it's a case that we have in our UIP condition the expected exchange rate for T+1, and we know what kind of variables are influencing this relationship. Let's insert the right-hand side into this equation, and then we get to this relationship here. The exchange rate depends on the ratios of the interest rates, realized and expected, and the exchange rate expected for the period T+2. Ratio of the two interest rates, the expected ratio in 1 year from now, and the expected ratio in n years from now, as well as the expected exchange rate level in n+1 years from now. Finally, we can come up with 3 reasons why the exchange rate changes today. The exchange rate changes today in case that the expected exchange rate changes. So if something happens here with respect to the last term, then of course also the exchange rate changes. The exchange rate will also change in case that the current domestic or the current foreign interest rate change. And the exchange rate also changes when the expected interest rate changes. So in case that something happens here in the middle part of this expression. From the last bullet, we get to know that the exchange rate change when the expected interest rate change. So we can once more ask the question, why do interest rate expectations change? But why is it the case that traders at the financial markets are sitting in front of their Reuters tickers? Why is it so important when the US announces its labor market statistics? When, for example, the realized unemployment rate is lower than the expected unemployment rate, the traders get an information that the US is in an economic upswing. Then traders immediately expect that US monetary policy will tighten in the future, so that in the future the foreign interest rate will increase. What is the effect on the current exchange rate? In case that the expected foreign interest rate increases, then the right-hand side increases and also the exchange rate increases. So this leads to a depreciation of the domestic currency. So when the expectations changes because of the fact that new information are released, then already today the exchange rate reacts. By this line of argumentation, by this chain of argumentation, you of course can now understand this last bullet we were talking about. We were talking about the fact that large swings can be explained by rational reactions to new information with respect to future interest rates and the expected exchange rate. So in case that these new information about the labor market statistics of the US are released, then it will be the case that already today we observe a change in the nominal exchange rate. Well, I can give a second example. What happens if the domestic realized unemployment rate is higher than the expected one? Then the domestic economy is in a downturn. Traders expect domestic monetary policy to loosen in the future, so they expect that in the future the interest rate will decrease. When the domestic interest rate decreases, the right-hand side of this equation increases. So this also leads to an increase of the exchange rate, which is a depreciation of the domestic currency. In the next few examples, I would like to highlight by how much the exchange rate will increase or decrease. We have to specify the basic scenario. Let's assume that both interest rates are assumed to be constant and equal to 5%. the expected exchange rate for the period t plus n plus 1 is equal to €1 for $1. And therefore, the current exchange rate in the basic scenario is equal to, like this chain of foreign interest rates, 105 to the power of n, divided by 105 to the power of n, the chain of domestic interest rates times the expected exchange rate. So the current exchange rate is also equal to €1 per US dollar. Let's assume now that a shock occurs and we ask the question, what happens if the domestic interest rate is expected to be lower in only one single year? So in one single year, the domestic interest rate is expected to be 3% instead of 5%. By how much does the exchange rate react? This can be computed as follows. The foreign interest rate does not change, so that the chain of foreign interest rates is unbroken. Once more, we have 105 to the power of n. But in the lower part, like in the denominator, we have the domestic interest rate, and there only in n minus 1 years, the interest rate is at 5%, but in 1 year, the interest rate is only at 3%. This can be computed as follows. So we are splitting up this relationship here in the following way, that 105 to the power of n is equal to 105 times 105 to the power of n minus 1. Then this term here will cancel out because it's in the numerator and the denominator, and we get for the current spot rate the relationship 105 divided by 103. So we observe here that the exchange rate increases from the level of €1 per US dollar to the level of 102 euros per US dollar. So in this numerical example, we are able to quantify the effect of this expected change in the exchange rate. Let's give a second example. Let's assume that the domestic interest rate is expected to be lower in 5 years. So for 5 years, it's the case that the domestic interest rate is expected to be 3% instead of 5%. How does that affect the nominal exchange rate? Once more, we have to come up with this relationship. So the foreign interest rate has not changed, but the domestic interest rate is only equal to 5% in n minus 5 years, and in 5 years, the interest rate is at 3%. So once more, we split up the expression in the numerator, then this term will cancel out, and we get to this relationship here. The exchange rate today is equal to 105 to the power of 5 divided by 103 to the power of 5. So the exchange rate today is at the level of 1.10 euros per US dollar. So these two numerical examples, they highlight that it's very important that we need to find out for how long is it expected that the domestic interest rate is lower than the foreign interest rate. In the first example, it was only in 1 year. And then, of course, the reaction of the nominal exchange rate is not that high. But when the domestic interest rate is expected to be lower in 5 years, then it is the case that also the effect on the nominal exchange rate is higher compared to the previous example.